Morning, my name is Elliott. I'm the editor of the Energy Strategist. Today is Wednesday. I wanted to talk a little bit about the oil inventory numbers that were released at 10:30 this morning. Trying to make this a weekly feature as well on the blog site at theselevels.com. This morning the government actually released that we had a build of 3.2 million barrels of oil. Expectations were for about a 2.7 million barrel a day build, or million barrel build overall. That's a little bit higher build than expected, so you would say that was modestly bearish for oil. However, really, 500,000 barrels at this time of year really isn't that significant. What I think is more significant is the fact that pretty consistently over the last 6 or 7 weeks we've seen builds that have been above expectations, above analyst expectations. And at this point in time we're actually seeing U.S. crude oil inventories a little higher than average for this time of year. Another interesting aspect of that report that I think wasn't as widely reported is the fact that the government reported that crude oil imports into the United States were about 750,000 barrels a day higher than they were over the same 4-week period 1 year ago. So in other words, crude oil imports are up rather sharply year over year this year. That does suggest that despite all the talk you're hearing about OPEC cutting production or not growing production, we are seeing pretty healthy imports of crude oil into the U.S. And I think that's been one of the factors that's contributed to this rather sharp rise in crude oil inventories we've seen over the last 2 months. So I see that as sort of modestly bearish for oil prices. Flipping over to U.S. motor gasoline inventories, we saw a 2.3 million barrel build versus expectations for about 375,000 barrel build. Obviously that's far above expectations. This really is, again, a continuation of the same bearish trend we've seen in terms of larger than expected inventory builds over the last 7 weeks. U.S. motor gasoline inventories are now well above the upper end of the average range for this time of year. In fact, we're setting new 5-year highs in terms of motor gasoline inventories this week and have been over the last 2 weeks. The final component of the report, of course, is distillates. Distillates would include products like heating oil and, of course, diesel fuel. What we're seeing is that distillate inventories actually fell about 2.5 million barrels. Expectations were for about a 2.2 million barrel fall. So they actually fell a little bit more than expected. That does tend to be rather positive for distillate prices. We're really about average for this time of year. However, I'd say if you look at the last 3 or 4 weeks, we've tended to see drawdowns that were a little bit higher than analysts had been expected. I do think that for the distillates, the main factor that we're seeing at work there is really the draw in heating oils as a result of the colder than average weather that we've been seeing over the last several weeks and are predicted to see really for the next couple of weeks. And that not only bodes bullishly for distillates prices, but also for natural gas prices. Obviously, we have seen natural gas inventories draw down a lot more than had been expected over the last several weeks. And we actually saw the largest ever drawdown in natural gas inventories late in January, a 274 billion cubic foot drawdown in 1 week. So what I see overall is that from a pure inventory perspective, the latest several weeks worth of inventory reports have been relatively bearish for crude oil. We have seen crude oil continue to rally despite those bearish inventory reports. Obviously there are other factors at work. Longer term though, over the next 3 or 4 weeks, I do expect that we will see some downward pressure on crude oil if we continue to see builds of this nature. Thank you very much.